Oh, well, guess what? All right, we are gonna get to welcome everybody. Welcome. Will you hold this for a minute? I'm gonna hurry and share to my groups. Okay, so feel free to share to your groups. You're gonna turn this right there. All right, everyone, welcome. I'm sharing. Feel free to do that yourself. Yay! Okay, here we go. All right, we love phones and computers and all technology, right? That's what we tell ourselves as we're having some issues, but we are going to resolve them really fast. Hello, Bethany said you did a great job with your taxes. Okay, you guys, here we are. We're going to have to squeeze together because my phone doesn't want to go sideways even though I changed the orientation. So, okay, yay! Welcome, you guys. Invite your teams. Invite your teams. Anybody who has a home-based business, we'll put the camera more on Matt. Anyone who has a home-based business can benefit, even though we will be talking more specifically about paparazzi accessories and our awesome $5 jewelry and your home-based business tax, because we all know that's our favorite conversation. Mm-hmm. I always tell people that our CPA is like, thank you so much for wanting to do that for a living, because that is the last thing on earth I would want to do.
That's the answer for a lot of people. They're like, there's no way I could possibly do that. I'm so glad you're alive too.
Yeah. To us, like taxes is like a swear word. So we try not to say that word at our house. We really appreciate Matt and his firm and anyone that has a desire to do taxes and to keep people like us out of jail or prison. You just don't go to jail. You go to prison for tax fraud, huh? I always tell people we love our CPA because he helps us save or get back as much money as possible and keeps us out of prison at the same time. So thank you. Welcome. Everyone, feel free to invite your teams or to invite people that are just associated and wanting questions about home-based business tax. This is about one of the only times you're going to get an hour or two of a CPA's time for free. CPAs get paid pretty well hourly. It is a pretty demanding, tough job with a lot of responsibility, and they get paid to do it. So Matt has graciously agreed to come help out lots of people at one time and give you some great advice about taxes. So yay! Yes. Okay. So we'll start in 1 minute. Let me hurry and just introduce Matt. This is Matt Jensen. Well, first of all, let me introduce me for you. I am doing it outside of my team group. In January, I did this in my team group for my team. But there were a lot of people outside of my team that heard about it and wanted access to it. But because my group is closed, basically only for my own team, they were not able to see that. And so I thought this time, there's a lot of people that have questions about taxes. I could do it outside of my team group so that the most people possible could benefit. I believe in the abundance mentality, which is that there's enough out there for everyone to have success, and that sharing something like this helps everyone instead of like hurting anyone. So that's why I'm doing it here on my personal page. I have no ulterior motives other than to help people. And Matt, he wants to help people too. He's our CPA. He does a great job, and even though this is your second time, this is his second time live on Facebook. The first time was last time. Are you even on Facebook?
I do, but I rarely.
Yeah,
I have a Facebook, but I rarely get on it.
He's not on Facebook much, so like his firm is calling him the movie star now because he is doing taxes on live Facebook. So, okay. Oh, business insurance. I don't know if you talk. Okay, so anyway, he is. I made him wear paparazzi. I'm like, you gotta represent. Show him.
I've got it right here.
Yeah. Last time we put the big, colorful bubble gum beads on, but this time I'm like, okay, you can wear an urban. So let me introduce myself for those of you that aren't on my team and don't know me. I am Johnnie. I am a jet setter with Paparazzi. Been in for 8 years, and I have one of the most awesome teams in the company. Not because of me, but because it's full of hardworking women and men that are providing for their families through $5 jewelry. So This is Matt Jensen. We both live in North Logan, Utah. He lives about a mile away from me. And we moved a year ago, and when I showed up at church, he was there, and I'm like, oh, look at that.
Small world.
Small world. So, he is a certified public accountant. I know he has a few other initials after his name somewhere.
I've got a CVA, which is a Certified Valuation Analyst. Means I can do appraisals on businesses. Okay,
so if you want to sell a business, he can help you with telling you and the person buying it how much your business is worth. And he is a dad to 2 very beautiful little kids, and his wife is so smart. Probably smarter than Matt.
Not probably, she is.
She's like this science, put stuff into space, and when she starts talking, I'm like, you are way over my head right now, lady. He has been a certified public accountant for
5 years.
5 years, and he does a great job with our taxes. Matt can tell you, Paparazzi can pay really good.
Oh, yeah.
At church on Sunday, he said, you know, Michelle, you chose a great job. And I said, I didn't choose a job. I chose an opportunity, and then I went after it. So, you guys, the great thing about Paparazzi or any home-based business is you determine your paycheck. You can make a lot of money doing when you seek out opportunities and go for it. So, is there anything else I need to say?
I think that's good.
Okay, so I will say this. Matt said he would answer questions during, okay? And I'll try to, filter them so he can concentrate on talking. But also he will share, you'll answer questions afterwards?
Yeah,
You can email him. I put his email and his phone number at the bottom, but please, please, please be respectful of his time. He is a professional. He works, many hours a week. If you have not watched this video fully, you need to watch the video fully before you ask him a question. I think that is being respectful, because if the question is answered in this video, he doesn't need an email about it. Does that make sense? So, all right, you guys, ready? This is his time to shine. And I'm like, there might be a couple hundred people on, and he was so excited about that. Yep. So, okay, it's all Matt.
Okay, so Michelle started. She sent me a bunch of questions that came in from everybody when we decided we were going to do this. And so I went through a bunch of those questions. I tried to filter as many of the similar questions into certain categories, and I'm going to talk about those. I know a lot of your questions are super specific, and it's hard to get that information to everybody. So if I don't answer your question in a way that's satisfying to you, just shoot me an email. I'll try to get back to you as quick as I can, so that you have the information you need. So with that, I'm going to start on the first topic that we hear most about. It's a very common question. The question is whether to have an LLC or an S corporation for your business. You've decided that you're big enough that you're going to establish a business.
Okay, wait. How big should you be? Okay, for all of you out there, we've got people that make a couple, like $100 a month to maybe $100,000 a month, $1 billion. When should you decide that you need this is called a legal entity. Should you get a legal entity, Matt?
For sure, if you've got gross sales of about $20,000, it's the time you got to consider, I need something else. I need something, a legal entity, a structure to help me be a better business, to coordinate my money, to begin to save on taxes in additional ways. So when you're getting about $20,000 of sales, that's the time to begin to have the talk about what's good for you.
So $20,000 of sales is about $9,500 of profit. Do you want the profit, or do you want your profit, or do you want total sales?
In this case, I'd say gross sales.
Gross
20,000 means total sales.
Okay, total
before
sales.
Profit.
Before profit. So if you're selling about $20,000 a year and that's including the cost of the goods and your profit, that's when you should start thinking about a legal entity. Okay.
Yep. And so that's just getting a legal entity. And the main reason to have a legal entity is protection from lawsuits.
That's a year, right?
A year.
Yep. So $20,000 a year, which is $9,500 profit. according to him, is when you should start thinking about a legal entity. A year, not a month.
Okay. And like I said, the main reason is legal protection. In your business, I haven't heard of a lot of lawsuits, but there's always the potential. And the big reason to have that entity is because it'll separate your personal assets from your business assets. Once you've established that legal structure, you're running your whole business through there, you've separated your bank account, your business bank account, and your personal bank account. If you're ever sued, someone can only come after what's in the legal structure, unless there's gross fraud. So that's a reason to, that's why you separate your business and your personal bank account. That's why your house is in your personal name, not in the business name. Your cars are kind of a toss-up. It's a personal decision there, but it's to protect you. So once you got about $20,000 of sales, you're doing a lot. It's time to think about, I need a structure. I want to separate my assets so I have protection in that case. Now, there's, the two structures everybody talks about is LLC and S corporation. For the purpose of this presentation, an LLC is an entity that's taxed as a partnership or as a sole proprietorship. You have to remember an LLC is a state designation for an entity. It's not a federal designation. So when it comes to tax, you're either a partnership or a sole proprietorship as one taxing structure, or an S corporation is the other taxing structure. So when I say LLC, that's what I mean. I mean a partnership or a sole proprietor, and an S corporation is another entity. Now, the biggest difference in tax for the two structures is going to come down to payroll taxes. And I've got a little whiteboard here. I'm trying to illustrate the difference from that. So I've picked a little bit of higher numbers to kind of help illustrate my point on why you might choose an S corporation over an LLC. Both of them provide the same legal protection. Both of them, you separate the assets. Is it flipped?
I gotta hurry and flip this, guys. I forgot to flip it once we went again. Okay, let me hurry and flip it. Okay. Here we go. Look at that. Did you guys know that you can flip your screen so that you can actually show things right? Okay, here we go. So you guys, really quickly, one of the reasons, do we have an LLC or an S Corp on our business?
S Corp.
Okay, so we have an S Corp on our business, and I'm sure my husband, he handles the taxes. I love my husband for this, but one of the reasons we have it, I'm breaking it down into Paparazzi. I'm a consultant. One of the reasons we have this is, say like I'm doing an event and there's a big windstorm and my tent goes flying. Now, keep in mind, we do weigh down our tent and everything like that, so it's less likely to happen because we're smart. We're liable, right? We are liable if we damage anyone else's property or whatever. But let's say hurricane strength winds comes through, picks up our tent, and it hurts somebody. That person could go after our business and everything else we own if we didn't have one of these things. If we have one of these things, they can't go after our home. They can't go after any other business we own. They can't go after all of our other stuff. They can only go after our business, right?
Right.
So these are to protect yourself, and don't you get better tax
Yeah.
And better tax stuff because of these. So okay.
I'm actually going to switch sides if that's all right.
All right, yeah, this is better.
So for this scenario, I'm using the same numbers on both sides. For an LLC and an S Corp, I'm just trying to show the difference in the payroll taxes that you're going to pay. So on both sides, an LLC and an S Corp, you have total income for the year of $100,000. Now for your deductions, in an S corporation, you have to take a wage, an officer's wage. If you have profit, you have to determine what a reasonable wage for your business is for the officer, for the amount of time they put in, and take that as a wage. So for the officer's wage, we decided a wage of $40,000 was a fair wage for the officer in this case. So that does count as a deduction on the business side. On an LLC partnership, you don't have to take a wage as an owner, as a partner. Now your other deductions, in this case, we're just going to say it's $30,000 of deductions. So over here, we've got net income of the business of $70,000. On this side, you still have the $30,000 of other deductions. Your net income is $30,000. Sorry, I've got my sheet here. I didn't want to have to do the math in my head, so I'm just double checking that I'm putting the right numbers on. So from the business side, we've got business income in an LLC of $70,000, an S corp at $30,000. But these structures don't pay income tax by themselves. They push the income out to the individual, and the tax is paid at the individual level. So on our personal return now, wage income, we didn't have to take a wage as an LLC. We've got no wage there. On our S corporation, we've got $40,000 of wage. Now the K1 is the form that the business uses to push income from the business level to the individual level. So $70,000 is our K1 income on our LLC side. $30,000 is our K1 income on our S corp side, for a grand total of $70,000 on both sides. So you might be wondering, I mean, you ended up with the same number. Why does it matter? Well, we're getting there. On your business return, I'm just going to assume you're going to take the new standard deduction. Assuming that you're married, it's $24,000. So you end up with taxable income of sorry to hide your face, Michelle.
Oh, I'm fine.
Of $46,000 on both sides. Income tax on that, if that's all your income, you're in the 12% bracket, you're going to be paying $5,520 in income tax.
Can you see it on the screen?
Yep, we're good. So here's the difference now. We're on to, I wrote sales. This is payroll tax. Is 15.3%. Now that represents the employee and the employer portion of payroll tax. So if you work for a company, you get a W-2, you're going to pay 7.65% of your income in payroll tax. Your employer has to match that. He'll pay an additional 7.65, and he sends that to the IRS. That's Social Security and Medicare. So that's payroll tax, self-employment tax, FICA taxes. Those are all the same thing, and that's what it is, Social Security and Medicare. So on the LLC side, your whole business income is subject to self-employment tax. So in this case, we have to do 15.3% of $70,000, which is $10,710, for a total tax liability of $16,230 of taxes on this side. For the S corporation, when we determined our wage up here, what was a fair, reasonable wage, we're basically saying this is the amount we're going to have subject to self-employment tax. So instead of paying self-employment tax on $70,000 like on this side, we're only going to pay on the $40,000 of the wage we chose, which is $6,120 for a grand total of $11,640 on this side. So I'm missing my number there. It's a little under $5,000 of savings just by choosing an S corp entity structure versus a partnership or sole proprietorship. Your savings is in the payroll tax by being able to choose what amount of income is subject to self-employment tax. Just a note on that wage, it does have to be deemed fair. If you're ever audited by a state agency or the IRS, and I mean you've got hundreds of $1,000s of income and you've chosen a $10,000 wage, they're gonna say, that's not a fair wage. They're gonna force you to raise your wage up, and then you're gonna have to pay additional tax anyways. So to avoid triggers for an audit, You should visit with with your CPA, with your accountant, and determine what a fair wage is, and then go with that amount in reporting. You can put that down, Michelle. We're covered there for a minute.
All right. Man, didn't that sound fun? I mean, whew, this is why we have a CPA, guys. This is why we have a CPA.
I know. The numbers aren't always fun to look at it like that. So a lot of you might ask, so shouldn't I just be an S corp all the time? Like, why would I ever be a LLC, a partnership, a sole proprietorship? Why would I choose that structure? And the answer is, with an S corp, there are additional tax returns you have to file. Your quarterly payroll reports. So it costs. To do quarterly payroll reports, your W-2 for the end of the year. The payroll reports go to the IRS, the state taxing agencies, the state unemployment. Depending on who you choose, it's going to cost you between $200 and $500 a year to file those additional reports. So that's why a lot of people might start off as an LLC, taxed as a partnership, and then as their business gets bigger, you have the option to switch to an LLC taxed as an S corporation. So that's a little bit of general information about both of those taxing entities, taxing structures.
Now, Matt, what if they don't choose an LLC or an S corp and they're just filing
you'd be filing under your Social Security number, and you are a sole proprietorship. The LLC column still applies to you. That's how partnerships and sole proprietorships are taxed. They're taxed the same way.
So would you be paying more taxes if you didn't create an LLC or S corp?
You wouldn't be paying more taxes. Sorry.
See, I'm throwing him hard questions, huh?
You'd pay less taxes when you switch to the S corp. But to make it worth it, you have to be making enough money to save more than that $500 you're going to be paying somebody to file your payroll reports, if that makes sense. What I'll tell you, in general, for our company, most businesses like this will recommend that they start as an LLC. Remember, an LLC is a state entity, and you choose your taxing structure. So an LLC defaults to the partnership or the self-employment or the sole proprietorship method of taxation. At any point, you can choose to file a form with the IRS and be switched to being taxed as an S corporation. But I mean, you can't jump back and forth. Once you switch to an S corp, you're not stuck with that structure, but you need to stick with it until it makes sense that you're not an S corporation. We can get that reversed. So in general, that's how most of our clients start. We'll start them as an LLC. Once they're big enough and determined that they're ready for it, we'll switch them to an S corporation and move on from there.
Okay, Matt, are you going to cover when people should file and all that later on?
Yes.
Okay.
I got filing dates. Okay. Let me make sure I didn't write this.
Dates, but just like when they should file. Okay.
Dates, there we go. Okay. Yes, I'll get back to that later.
Okay.
I'm just trying to hit the things with the most questions first in case we run out of time.
All right.
So I'm going to leave it at that for LLC partnership entity structures. I totally suggest setting one of these up. Once you've got $20,000 of income, I would totally suggest setting up an LLC at least an LLC. You can set up what's called a single member LLC. You don't have to file an additional tax return. There's deemed only one owner, so if your husband and wife working together, you have to say, well, you're the owner, but you don't have to file another tax return. Once you have two partners in an LLC, you have to file a business tax return, so there's another tax return. And an S corp also has an income tax return. So making those structures, I mean, there are costs to filing and the tax returns, all that. So if you have questions on that, if you're trying to decide, is it time to switch or not, talk to your accountant. You can call me, email me. I'd love to help you out with those questions. But other than that, that's kind of where I'm going to leave it with that topic for the moment. Is that all right?
Yep. So you guys, if you're on my team, I suggest if you're making over, a couple $1,000s a year, get a CPA. Even if you're not making that much profit, a CPA will help you get more back in your taxes and will keep you out of trouble and will be able to answer these hard questions. Mm-hmm. Obviously, this is not Chris's and my specialty. We don't know this stuff, so we count on someone who's been educated and who reads the tax laws and knows all those fun details to give us a professional opinion and what is best for us in our situation. So yes, if you're doing this for more than a hobby, I would recommend having a CPA do your taxes, and they can tell you whether an LLC or an S corp, if you need that, and which is probably best for you, and like the difference between the two. So he's given us a broad overview. For specifics, you really should seek out a CPA to help you with your taxes.
Okay. I've seen the question a couple times pop up here, so I'll answer it now. So people are asking about Schedule C on a personal income tax return, and that's a business on your personal tax return. So if you're a single member LLC, you're filing a Schedule C on your 1040. And if you don't have a single member LLC set up, you're filing under your Social Security number. I mean, it's the same place. So I hope that answered that question for those couple that asked it. The next topic I want to talk about, get a lot of questions on, is the jewelry you purchase, also inventory or cost of goods sold. All three of these things are related. They're basically talking about the same thing. Got questions on how to figure those things out. So the first thing you have to know is your jewelry you purchase. You take the deduction for when you purchase the jewelry in the year you sell it. So if you're trying to get a ton of deductions and someone says, well, just buy a ton of inventory in December, really, you're not getting the deduction this year. You're putting that deduction on your balance sheet as an asset, and that is saving it for a future year to deduct. So just remember that. The year I sell my jewelry is the year I get to deduct the cost of that jewelry.
Oh, wow.
So, don't purchase a ton in December trying to save on taxes.
That's good to know, right?
Yep. I do have another little sheet to kind of walk through this. It's actually, I messed up on the first page, so go back to... There we go. So, a lot of people ask, how do I might say, what are your cost of goods sold for the year? Or... your CPA might ask, what's your ending inventory and your beginning inventory? And you might ask, well, why is that important? This is why. Cost of goods sold, also called COGS, is determining how much of the jewelry you purchase this year you get to deduct this year. So, in this scenario, the end of 2017, you had $2,000 of inventory. So, for 2018, your beginning inventory is the $2,000 you had left at the end of the year. Now, let's say you purchased $40,000 of jewelry during the year. We're going to add that here. I'm going to subtotal this to $42,000. This is your goods available to sell during the year. Now, your CPA should be asking, what's your ending inventory at the end of the year? And this is this part. At the end of the year, we do an inventory count. We determine we have $5,000 left at the end of the year. We're going to subtract that, and we come up with $37,000 of current year cost of goods sold. This is your deduction you took this year. A lot of people think, well, I purchased $40,000 of inventory this year, so I should get $40,000 of deduction. But at the end of the year, you had $3,000 more of inventory than you did at the beginning of the year. You've got $3,000 of goods that you're still waiting to sell. And that's why it's important. You take the deduction in the year you sell the inventory. Now, I put my note here again. Inventory is a deduction saved for future years. It's sitting on your balance sheet. It's an asset. And next year, let's say your inventory is $1,000, that means $4,000 of this inventory is an additional expense for next year. I can see that question coming up, and I got this a lot last year. When you talk about inventory, cost of goods sold, it's the price you purchased it for. It's not retail cost. It's not what you're going to sell it for. What did you, as the consultant, purchase the inventory for? That's good, Michelle. Can you put that down? So, you're purchasing the jewelry for $250. What is it?
$275 plus tax.
$275 plus tax. So that is your cost in inventory. $275 plus tax goes into inventory, goes into cost of goods sold, goes into purchases. It's not the $5 plus tax. So I hope that answers that question. Trying to think. I know that's a little brief on inventory, but that's the 3 numbers your CPA should be asking you about. What was your beginning inventory? If they've been doing your taxes for a couple of years, they should have that number on file. What are your current year purchases? And what is your ending inventory? That way they can calculate what your current year deduction is.
Okay, one question fast. Okay, so do you include the tax and the shipping in that number of cost of goods?
I would for ease. Some people wanting to track it better might say, let's break it all out. I've got my actual cost of jewelry, I've got my shipping cost, and I've got my tax. And they might decide that there's a reason for them to track it that way. They want to know, is my cost of shipping changing all the time, something like that. So they want to track it separately. But for most people, I would say...
Somebody has to see it one more time.
Okay.
One more time, guys. Oops. It's backwards. It's hard. Okay. Here it is. One more time, guys. You can keep talking, Matt.
Okay. But I think for most people, we're not necessarily worried about shipping costs changing. Sales tax is what it is. So I would just say, just throw it all in the cost of goods sold. It makes it a lot easier to track it. Because you're going to say, well, I've got this charge to Paparazzi for $5,000. And, it was all jewelry. It'd be easier just to say that's all cost of goods sold instead of, well, $4,500 the jewelry, $300 for shipping, $200 for tax. You're going to get the deduction on all of it at the end. Me personally, I would just put it all into cost of goods sold or inventory.
And that might be like a CPA's, like a different CPA might say something different, right?
Yeah.
So that could be based upon the CPA that you use, what they tell you to do.
Yeah. Another question I can see right there, that's the cost of shipping that Paparazzi charges you to get it, or the cost of shipping when you sell it to someone else. That'd be the cost of shipping when you receive it from Paparazzi. You're going to deduct the cost to ship it to someone else, and postage and shipping is another deduction, but that is not cost of goods sold. It wasn't the cost it took you to get what you're selling. So, I hope that answers that question. Couple questions on if you have a helper, someone who's helping you to do the parties, to ship your inventory type stuff. What do they need to know about that? So the first thing is, do you have an employee or an independent contractor? The reason this is important is an independent contractor you don't have to do payroll reports on, you don't have to pay the employer portion of FICA taxes, whereas an employee you do. And once you have an employee, you'll have, now it slipped my mind, workers' compensation insurance. So people might say, well, I definitely want to have a subcontractor, an independent contractor. And the thing is that it's not something you can choose. It's determined by, there's a couple things that determine whether you have an employee or an independent contractor. And the 3 main things the IRS looks at, they call them behavior control, financial control, and your relationship. So your behavioral control is, can I tell them when to show up to work? Do I give them their computer to work on? Do I tell them what to do? Am I providing their training? Am I... just basically I can tell them what they need to do. Is your behavioral control. If you can do all that, more likely than not you have an employee. The second one is financial control. I mean, do you say, I'm going to pay you $8 an hour? Do you determine the wage? Are you providing the things that they need, the computer, the supplies? Most of the time, if you have an independent contractor, they're giving you an invoice per job. I'm going to do this job for you, and it's going to be $1,000. They're not, I work for $8 an hour, and that's not always the case. But in general, I mean, they're paying for a job. I'll do this job for you. It's going to cost X amount of dollars. So if you kind of determine that, you've got an employee, not an independent contractor. The last one is relationships. What kind of contract do you have? What kind of agreement do you have for services? Do you provide benefits, health insurance, life insurance, 401k? Are you providing anything like that? Company car, something similar to that. And then the length of the engagement. I mean, if you have one person who's working with you for a couple of years, it's more likely you've got an independent contractor. Independent contractors are very short jobs. I have this job, it's going to take a week, and then it's done, typically, type thing. In most cases, if you have a helper, it is an employee. I'd say 99 times out of 100. I know this is something that, you can work with your helper, and then they want to be an independent contractor, so it's not likely, if they want to be and you want them to be, it's not likely that it's going to be caught, because there's no one complaining that says I should be an employee. But if you're ever audited, when you get audited from state unemployments, they ask for, I want W-2s, 1099s, description of what everybody's doing, how much you're paying them. So in those audits, you're going to say, well, here's so-and-so, they ship the inventory, they do it from my house, I pay them $8 an hour. That's when your state agency is going to be like, well, that should be an employee, not an independent contractor. So that's what the law is. I know there's people who work with their helper, they'd rather do it as an independent contractor. Just know that's the risk. If you're ever audited by the state unemployment agency, they can switch them to an employee, and they can go back and collect back taxes on when they should have been an independent contractor. Safest to do it right from the beginning, but just so you know the risk, that's what's there.
Okay, so let's see. I saw some things about 1099. If we don't have an LLC or an S corp, you file your taxes with a 1099 for Paparazzi, right? Or do you do Schedule C? So Paparazzi will send you a 1099.
Send you the 1099,
and then you
put that on your Schedule C to do your business taxes.
Yeah. So Paparazzi, if you make over $600 with Paparazzi in commissions from them, does not include your personal commissions from your sale, but if you earn over $600 in commissions from Paparazzi, they will send you a 1099, and you attach that to a Schedule C to file taxes.
Mm-hmm. Those 1099s should be issued individually to Social Security numbers. Or, I mean, if you've set it up, I don't know if Paparazzi allows this, actually, I should have asked you earlier. If you set up a business, we've got 7 of us doing business together. They can issue it to that EIN, but then you're splitting the money between the 7. So typically it's going to come to you to your Social Security number. If you set up a business, it will be under your EIN number, but it should be sent on an individual basis like that. Kind of jumping back to the employees, just real brief. If you have an employee, I mean, you're doing payroll reports, and just real quick, you file a quarterly payroll tax report with the IRS. It's called the 941 to report the wages and withholdings. That's where you pay your Social Security and Medicare taxes. You have a quarterly report with your state taxing agency, and remit your state withholdings. And then the state unemployment has a quarterly report as well. And then at the end of the year, there's 2 extra reports, an extra one to the state and an extra one to the IRS. So it's involved, but if you have an employee, you have to do it.
Unless you want to end up in jail or paying big fines and
Yes.
The thing that I always think about is if you're honest and you have integrity, you're going to do it right the first time, and you're not going to have to worry about the IRS coming after you, and you're not going to have to be worrying about paying back taxes. Plus, don't they charge interest on stuff?
Yep.
Plus, if you were trying to skirt the system and, do things incorrectly to save a little bit of money here, if you get caught, it's going to cost you a whole lot more than doing it the right way the first time, right?
Correct.
Because not only will they fine you, but they will charge you interest on what you should have paid the first time.
And the penalty.
So, this is another reason, if you have employees, to have a CPA to help you.
Oh. Okay, I'm moving on from that. I realize we're going through this kind of slow. I'll try and speed it up just a little bit. I know last time we went about 2 hours, and that was a little long for people, so I'm trying to get through the main thing. So, moving on to sales tax. A lot of questions on that. Things to remember, the number one thing to remember about sales tax is charged to the end user. The person who's going to consume the good is the person who should pay the sales tax. So, just distribution in general. The manufacturer doesn't collect sales tax when he sells it to a wholesaler. The wholesaler shouldn't collect sales tax when he sells it to a distributor. The distributor shouldn't collect sales tax when he remits it to the stores, the retailers. But the retailers collect sales tax when they sell it to customers who are going to use the goods. Now, businesses like Paparazzi or doTERRA is another example. The IRS realizes, you know what? If we've got 50,000 people selling the goods, those who honestly make the mistake and forget to do sales tax, and those who purposely are doing it forget to do sales tax, is going to be pretty high. Sales tax is something very misunderstood. It's terrible to do because every state has its own system, its own rates. You got local rates, county rates. It just becomes a nightmare, and the IRS cannot afford to audit however many consultants there are out there to collect sales tax. So what they've done is they say, well, we're gonna make the distributor collect the sales tax,
which is us, the independent consultants, right?
So Paparazzi's charging you guys the sales tax. So Paparazzi is collecting the sales tax that you guys should be collecting when you sell it to the customers. That's the way the IRS is determined. That's how we're going to get our sales tax. Mm-hmm. That's how we're not going to get cheated, pretty much. So you're paying the sales tax on behalf of your customers, which is why when you sell your goods, you should collect sales tax. You're selling, I bought this from Paparazzi for $2.75 plus sales tax. I should sell it for $5 plus sales tax because Paparazzi's already collected it from you, but you're not the end user. You shouldn't have to pay it. The customer should. Now, you're going to charge $5 plus sales tax, but you're not filing sales tax reports because Paparazzi's doing it for you. So that's what when you bill a client, here's your invoice, and you bought 5 things, it's $25, your sales tax is $2.50, but you're not going to remit that to the IRS.
You're just reimbursing yourself for the tax that you paid when you bought it from Paparazzi. So I always tell people, if you choose not to charge tax, it's like you going to Lowe's and them always paying your tax for you. It's nice, but most businesses don't do that. When you go to the grocery store, they're going to charge you tax. When you go to Lowe's, they're going to charge you tax. When you things like that. So, but we don't have to remit sales tax quarterly to our state, the state we live in, because Paparazzi has done it for us. That is a headache that has been taken away from us because of the way. You should be
thankful you don't have to do it.
It's a headache, you guys. So be grateful if you go to a CPA that doesn't understand direct sales, and especially Paparazzi, and they say, well, you need to send in sales tax. You don't. Okay? You don't have to.
So, a couple questions I've seen come through. What rate do you collect? I wouldn't worry about rate. I'd look at what Paparazzi charged you and charge that. So if they're charging you 40 cents on a piece, charge 40 cents when you sell it. if you overcharge sales tax over what Paparazzi collects from you and are audited, that'd be a red flag. Get in trouble with that.
Yeah.
So
don't round to 550, people. If you're on my team, you know I say that. That's kind of illegal, actually.
So let's see if I can find that other question. Sales tax is a deduction. Remember, it's included in cost of goods sold. You've got your inventory, your sales tax, and your shipping from Paparazzi, all in cost of goods sold. That's where you're taking the deduction. Someone asked about states that don't charge sales tax. If that's the case, Paparazzi shouldn't be collecting sales tax from you when they sell it to you, so you shouldn't be charging.
Paparazzi charges the tax where it is shipped to, so they're not charging Utah tax. That is not correct. Paparazzi charges tax based on the zip code that it is shipped
Destination
to.
zip code.
So if you look at your invoice and you're like, whoa, this is really high, just realize it is based on $5, not $2.75, and it's based upon the rate of wherever it is shipped to. So Paparazzi, Trent says they have a big book, and like a person that's like basic full-time job is to make sure they are in line with sales tax.
It's going to be more than a person.
Yeah.
I can guarantee you the Paparazzi has a team of people whose only job is sales tax. This has become a headache for so many people within the last year on recent court cases that overturned a lot of rulings. So sales tax is a huge thing. Be grateful that Paparazzi's doing it for you, but don't pay the customer sales tax. Collect the sales tax.
And that's coming if you want to make money. If you're not charging sales tax, you're not making a 45% commission because you're paying your customer sales tax out of your profit. That's what happens if you don't charge tax.
Yep. I think I'm done with that one too.
Okay.
So, if you have questions with that, email me.
Really quickly, that question I asked you before. So if you don't charge sales tax and you pay all the sales tax for your customers, everybody says, well, it's a tax deduction, right?
You've already taken it in cost of goods sold. It's not an additional deduction. Don't double deduct it. You've already taken it when you purchased the goods from Paparazzi. All you've really done is cut into your own margin, made your own profit smaller.
Right. And you're not going to get dollar per dollar back.
Oh, that question.
Okay? Because people will say, well, my tax was $600. That means I'm going to get $600 back if I don't charge it. That is not true.
So we talked about this before we started. I'll talk about that now. It's the credit versus deduction. A tax credit is a dollar reduction of tax. A tax deduction, you're going to take your tax rate times the deduction, and that's times the amount, and that's your deduction. So if you invest in solar panels on your roof, there's a tax credit for that. You get a $6,000 tax credit. That reduces your tax $6,000. You buy $6,000 of supplies. That's a deduction, not a credit. Your tax rate is 12%. You're going to take 12% of $6,000, roughly $700. That's your deduction, or that's the reduction in tax you're getting from your $6,000 deduction.
Yeah.
So
if you choose not to charge sales tax to your customers, you're not going to get dollar per dollar back what you didn't charge. Okay.
Correct. Okay, moving on. Had a couple questions. I'm on what states you need to file your personal income tax reports in, your business income tax reports in. Now just remember, income tax and sales tax are different, completely different. So while Paparazzi, you might, if I were a seller on Amazon and I sold to every state, I'd have a sales tax liability in every state. But I only have an income tax liability in a handful of states. The things you have to ask about that, it's called domicile. Where is your business located? Where is your headquarters? Do you have employees in different states? Do you go to events in different states? Or some of the questions you need to ask. If you travel to a different state to do sales at fairs, you've picked up a filing requirement in that state. If you've got employees that work in a different state and they do sales for you over there, you've picked up a requirement to file in a different state. But just because you sell to somebody out of state and you mail it to them does not mean you have to file in that state. Just so you know. The main, for most of you, you're doing a home-based business. Your filing requirement is in your home state. If you do travel to a different state for fairs, that's probably the only other time you're going to pick up a filing requirement in a different state. There was a question about if you have a filing in another state, how do you remit the tax to that state? Remember, you're going to file a multi-state business return, but then the Form K-1 from your business, if you have an entity, is going to push the business to your personal return. If you're just filing on your personal return, when you do your Schedule C for your business, that's where you break out your income, your deduction by state, and if you have a CPA, most of their softwares will calculate that. And that's how the income tax is remitted for multi-states. I don't think I need to go into that more. Yeah. It's not going to affect most of you.
Yeah.
If you have questions, email.
Or talk to your CPA.
Filing requirements. When you have to file.
Okay, how much should somebody make to file? If I made $300 profit, do I need to file for this?
If you made $300 profit, you went over the $600 total for sales, you need to file. In general, most of you who are doing this as a business, it's not a hobby, you should file all the time. If you've got a loss, you're going to take the loss as a deduction against other income. If you have a small bit of income, if you're under $600 of income, there's actually not sales tax or self-employment tax collected on less than $600 of income. So it's going to add to your income a little bit for taxes, but you're not paying additional sales tax. But then, I mean, you should almost always file. This is your business. This is something you're trying to do to make money. If you have a loss, you're going to offset other income, reduce your tax burden for the year. If you have income, I mean, it has to be reported anyways. So almost always file.
So did you hear that, you guys? If you are losing money, and there's lots of ways that you could lose money but still make money. It shows you lose money on your taxes, but you actually make money. You want to file, even though you're showing you lose money, because that's like a deduction and can help you make more money in other places with your taxes, right? So our first few years in Paparazzi, we showed basically that we lost money, and that meant we got to keep more money out of Chris's paycheck. So showing a loss is not an awful thing, and filing is probably good and will keep you out of trouble.
Mm-hmm. The general rule is you do need to show a profit from a business once in 5 years. That's one thing the IRS will be like, well, you haven't shown a profit in the last 7 years. We're gonna say this is a hobby, and you have to prove that it's not. Questions on hobbies: hobby versus business. A business, you can deduct all of your expenses. A hobby, you can only deduct the expenses up to the amount of income you make. So if you don't make any income and you have $5,000 of cost into it, and that's a hobby, nothing. You don't get anything. Hobby versus business. A business, you're trying to make money. So if you can show to the IRS, I am in this to make money, I am trying every way I can, it's a business. A hobby is the guy who likes motorboating, so he buys a boat and tries to write it off as a deduction while he's water skiing with his family. So, just don't be over aggressive. I mean, it's the main thing. Think about it. What's your purpose with what you're doing?
Right, and some things that, correct me if I'm wrong, some things that the government will want to see if you're trying to deduct a lot of money as a business is they want to see separate bank accounts, right? So a CPA would recommend that you have a separate bank account between your personal and your business. Usually if you're deducting a whole bunch of miles, they don't want a lump sum, but if you ever get audited, they kind of want to see specific dates that you went miles instead of like, oh, I went 5,000 miles last year. Well, like we used to keep our calendars to show when we were going places, and now we just have an app where we enter in things like that. What else do they want to see that says this is a business, not a hobby?
They're looking for how you're trying to make money, or what's your advertising. How much time are you spending actively trying to sell your product?
If you do it
type of expenses.
If you only spend 1 day a month, are they going to think that's more of a business or a hobby? Does that matter like that?
1 day a month, only a couple hours.
And you're deducting $5,000 or $6,000 a year?
They're probably going to lean towards hobby, but it comes down to what you can prove that you're trying to do it. There are several people. We have several clients, so they don't do a ton of work. They don't work very often, but when they are, they're actively, this is why I'm making money. I'm trying to do something out of it. I'm advertising. I'm meeting with people. Even if they only work a couple days a week, they're able to show that it's a business because they can show their purpose in it. Okay. So you just have to back yourself up with, how am I trying to sell? How am I trying to make money? Look at your deductions. If you're not making a lot of money, yet you're trying to write off a side-by-side to haul your stuff to the local fair, that's going to be a little bit of a red flag.
Yeah, well, there are people buying trailers right now.
And that's a common one. That's a common one.
If you have pictures that you have your jewelry in a trailer, it is a tax deduction.
Yep. You just have to show, this is a business purpose. I travel out of state 3 weeks at a time to hit state fairs to sell jewelry. I bought this camper so I don't have to pay $200 a night for a hotel room because I'm going to do this for a long time, and eventually I'm going to recoup the cost of the camper. It's a deduction. But that probably, if you're doing that probably means you're selling a lot of jewelry, you've got higher income. Now, if you're only making $5,000 and I'm going to try and buy a $100,000 camper, the IRS is going to say that's excessive. You could have made do with the cheaper camper. This looks like you're just trying to buy a nice camper and use it personally. You just kind of have to, it's kind of situation by situation. Talk with your CPA, and then what's your purpose in it? How is it going to help the business? Okay, moving on real quick. Filing dates. If you are a sole proprietorship, you don't have a business set up, you have a single member LLC, you're filing on your 1040 is what you're doing. Your personal tax return. Due dates for that is April 15th. That's when you're going to report the prior year's business income and expenses. It has to be done by April 15th. Now you can get your 6-month extension, so you get to October 15th to file.
That's what we do. That's what we did. Oh.
So, sole proprietorship, single member LLC, doing it under your own social security number, that's your filing dates. If you've set up an S corporation, you're filing an 1120S. If you got an LLC set up as a partnership, you got a couple partners, you've got your own, you're filing a 1065. Those two tax returns, your due date is March 15th, or you can get a 6-month extension to September 15th. Once again, for the prior year. So you have time to add it all up, get your income right, make sure your bank account's right, you've got it all. For your income tax purposes, those are your due dates. March 15th for an S corporation or a partnership with 2 partners or more. 1 person, a single member LLC, you got April 15th or October 15th if you do the extension. If you have payroll reports, you have quarterly deadlines. So if you have employees, you're filing quarterly reports, you have additional deadlines in April, July, October, and January. Those can get kind of, each state's different. You have to look it up if you're doing those. That's all on with filing dates. There are a couple questions about withholding for income tax. You have an S corporation, you can withhold on your W-2, or you might be paying quarterly estimated payments. What's the best way? So here's what you need to know. The IRS wants their income evenly throughout the year. The IRS, the government can't survive on getting all their income in 1 or 2 months of the year. They're trying to get as much as possible evenly throughout the year to keep things running smooth at the federal government. So if you don't withhold on a W-2, if you withhold on a W-2, even if you withhold all of it in December, it's counted as being evenly throughout the year. If you're not withholding on a W-2, you have the 4 deadlines again of April, July, October, and January when you need to make quarterly estimated payments. If you miss one of those, you're not even throughout the year. The IRS can assess a penalty. Most of the time they don't, unless we're talking big dollar amounts, or you only made one estimated payment. So what's the best? It's really a personal. It's really your personal situation. You need to find out how much do I need to withhold. If I can do it all on a W-2, you can withhold it all, do it all once a year, and it's counted evenly and gets you out of that penalty. So it's kind of that one's kind of specific to you. You should talk to CPA and accountant about that to determine what's best for you. Just real quick rules about that. To not have a penalty, you have to withhold 90% of the current year tax before you file your tax return during the year, 100% of the prior year tax, or your withholdings less your tax liability is less than $1,000. Those are the 3 rules to get out of the penalty for not having it even throughout the year.
Oh.
So
we pay quarterly tax, and then when we do our taxes, we pay more tax. Whoever said that wealthy people don't pay tax, they don't know what they're talking about. So that rhetoric that I hear going around with different is not true, okay? Wealthy people pay tax. We pay a lot of tax, right?
Yes.
And I said to him, how can we get out of paying tax? Can we donate more to causes? Can we donate? Can we do? And what do you remember your response?
I don't remember on this
He
one.
said, Michelle, you will always be paying taxes. You cannot deduct everything and not pay tons of tax. So, you know what you hear with the kind of politics that rich people don't pay taxes? That is false. So please don't continue thinking that that is true. That is not truth.
Yeah, just along the lines of that. To get out of tax, you basically have to spend all your income or invest in things that provide credits, which usually are very expensive, to get your income tax down. There's very few free credits in the world to get your taxes down. If you make money, you're going to pay tax. I pay tax. I'm a CPA. You can't get out of it. So
we pay a lot of tax. Gone are the days that we did not pay a lot of tax.
Okay. Moving on, a lot of questions about how to tracking your expenses and income. What's the best way? Really, it's up to you personally. What's the most convenient way for you to track your income? But it needs to be in a form that is makes it easy to throw together for an income statement. So we recommend QuickBooks Online to a lot of people. That's a way to it records your transaction from the bank, and then you can make it into an income statement. Be able to track your expenses that way. I know that Michelle and Chris use Deductor.
We used to. Deductor got bought out by Hurdle something. So we used to use the one that Paparazzi had in the back office that was $10 a month, I think. But that we could keep track of our miles, we could keep track of multiple businesses, we could keep track of charity donations, medical expenses, everything like that. So find a good one.
Okay.
And keep track of stuff.
I've had people who give me an Excel file, and on every page is a different category. So we got advertising, cost of goods sold, bank charges, and then they just put the date and the amount, and then at the end of the year they just grab the total from every sheet and put it on a main sheet that shows all their expenses. There's no one perfect way. I will say QuickBooks Online is becoming extremely convenient to share information between clients and accountants. And it tracks the information from your bank account It makes things really easy, and you can teach it rules to auto-classify certain transactions that makes recording your information easy for you. And you can pull it up at any time and see exactly where you are, income, expenses, here's my net profit. But, I mean, there's Quicken, there's Peachtree, there's a lot of those ones out there. Just have one that you can put your information in, and it's best if at any given time you can pull it up and be able to see here's how I'm doing for the year, my income versus my expenses. It's really a personal decision again. I hope that answered people's questions. I'm sorry if that's not what you wanted to hear, but there's not a lot for that.
Okay, we haven't talked a lot about deductions. Okay, one of the great things that I tell people about having a home-based business is that you can deduct a lot from your profit to show that you're not making as much money, and that will drop your overall what you have to pay taxes on. I always say you make money with a home-based business. It's not that the government pays you to have a home-based business. It's that they don't take away as much money with a home-based business, because you can see right here, right? This part of my house is a tax deduction. And there's things that you can deduct that normally, if I didn't have a home-based business, this part of my home would not be a deduction, right?
Right.
And so, Matt, will you touch on the common deductions that we can make with a home-based business, and especially with Paparazzi consultants, that you need to be keeping track of, so that when it comes tax time, you can mark those down as a deduction, which means it lowers the amount of money that you're going to have to pay. You get to keep more of your money when you have deductions.
Right. So common one I got asked about is mileage versus gas on a car. You're using your car, you're going to events, going to the fair, going to the post office. What counts? What's best? I'll tell you, for most, mileage is going to be better than gas. You have the two ways you can do it. It's called actual expenses or the mileage. The mileage rate, it has a portion broken out for depreciation of a car, for your fuel, for your insurance, for your licensing. You just have to keep track of the number of miles you drive, multiply it by the annual rate, and you get your deduction. Versus if you're going to do actual expenses, you can deduct a portion of your car that's considered business use for depreciation. You can deduct the gas that's for business use, your interest, your insurance, all that. But it gets hard when, I go to a party 2 times a week, but the rest of the time I'm driving around. So what portion of my $50 in gas is actually business, I have to keep this receipt. I determined that I have 7% of my car, 15% of my car use, 30% of my car use is for business. Well, here's my receipt for $50 in gas times 30%. It's just easier to keep a mileage log and say, on January 2nd, I went to the X and X place to do a party. I went to the post office. I drove 5 miles. And then at the end of the year, you just add that up, multiply it by the rate, you get your deduction. You do need to keep a mileage log. If you don't have a log, you don't get a deduction from the IRS. I was talking with a coworker about one. A guy claimed it's like 15,000 miles for the year. He got audited for a couple different reasons. They said, well, show me your mileage log. And he said, well, I don't have one, but here's my calendar, and on these days I travel to this place, it's X number away. Well, the IRS disallowed his entire deduction. He didn't keep a log. They took it to tax court. Tax court hates all or nothing, so the IRS disallowed everything. The tax courts hate that. So they were able to work out a compromise. They were able to work out an 80% of the original deduction compromise in tax court. But that guy just paid our firm for 3 hours of going to tax court for a deduction he already had that he just needed to keep a mileage log. Keep a mileage log. I think that mileage is a better deduction out of the two. What you need is the date, where you went, how far you went, and the purpose for the trip. That's all you need.
A lot of like the program that we use that I have on my phone, it asks those questions. So when I go do a trip or go to the post office or whatever, I just enter it right in my phone and it keeps track of that log. So a lot of apps that you use for taxes will have a mileage log in it, which is a great reason. If you can have one on your phone, it's perfect because it's right there. Do your mileage right when you drive in your garage or pull into your driveway.
So I can see the question right there. What if you're combining a business and a personal trip? I'm on the way to the post office, and then I'm going to go further into town to Walmart. Well, just record your miles from town to the post office, from home to post office, and then after that it's personal. So you did miss out on half the deduction, 5 miles to the post office, 5 miles back, but you're going to go to town anyways. Just the business portion.
Yeah. If you are, okay, Matt, what if I'm going to my mom's house who's 2 hours away and while I'm there I sell jewelry? Is that a deduction?
I would take it. That might be seemed a little aggressive, but part of my purpose in going, I was planning on selling when I went there.
Right.
I would take the deduction.
So you guys, if you're going on vacation or whatever, take your jewelry along. Pass out business cards. Sell some stuff. Have a party at the place you're going. If you have a party at the place you're going, you can show you did business with that mileage, okay? So there are ways that you can get some tax deductions for stuff that you're already going to do.
We're already going to do, and really the trick is but what we're doing is converting some of our personal expenses into business expenses. You have to be careful on this. Try not to be too aggressive, but that's what we're doing. We are going to go visit our mom, but we're planning on doing a party at mom's house while we're there. She's got a ton of friends coming. Yeah, I'm going to stay for 5 days later, but I can show I did a business transaction and justify it. Every CPA might be a little different on that. That is kind of how aggressive does the CPA want to be, their own interpretation. But keep track